Common misconception that Trinity Mercy Center is a soup kitchen. And the truth is that we do serve meals to those in need. But what we actually are is a church. We are a church with one mission, and we have a mercy center that as a part of our church. And so at Trinity Mercy Center, what we do is we worship together. Just like many churches that you might be involved with, we worship together on Sunday morning. We worship together in fellowship and Bible studies. We come together in fellowship outside of the church, and we also have an outreach, which is our Mercy Center. And our Mercy Center has wraparound services for those who might need to talk with a social worker for one reason or another. They may have lost an identification card. They may be looking for work. They may be looking for help with mental health in Greenville. So we offer an array of services through our social workers. And a lot of the people whom we serve at Trinity Mercy Center are either in active addiction or they are experiencing homelessness. And so we meet people where they are, because that's what Jesus is. That's what Jesus does. That's what Jesus did in his mission here on earth. And so we as followers of Jesus Christ, we also are meeting people where they are. And so every day we have people that come to us in different modes of crisis, and we try just to help them discern their next step and work through some goals and take each step at a time. And we sit with them in that space as they take those steps. We do our best to work with those who are in active addiction. We have different community partners and who we work with that help us to find rehab centers, whether it be outpatient or inpatient. And we work with lots of different community partners, but what really sets Trinity Mercy Center apart is that we are a church, and that we are first and foremost a worshiping the body of Christ that seeks each faithful step one at a time. So we are a non-denominational church, but we're really more multi-denominational. We have all kinds of different faith traditions and backgrounds that come together every Sunday morning, and we come together around the greatest commandment: to love God with all of our hearts and our minds and our souls, and to love our neighbors as ourselves. And so we do that. We do that actively each and every day that we're there at Triune. We do offer meal services. We offer meals on Saturdays and Sundays and on Monday mornings. We're also a food pantry. And so on Wednesdays, we have another vast array of services in which individuals can come in and get a bag of food. If they need it, if they are housed, they can get food they can prepare. If they're unhoused, we call a pop-top bag, and that's food that they don't have to prepare. Of course, we're working with each individual and hopeful that we can take that next step towards self-sufficiency and housing. And additionally, on Wednesdays, we do offer legal services, both in civil and also criminal court cases. And so we have lawyers that come in and volunteer. Now, they don't represent, but they do offer legal counsel. We also have people from Favor there to help with those who are in active addiction and looking to have a counselor that follows them. We also have someone that can help individuals that qualify to get cell phones, because at this day and age, it's very difficult to survive without having a way to communicate with someone else. And so we are a collaborative group of people, the body of Christ, that are coming together to help those who are in need. And we do this out of the overflow of the love that we have for and from God. And so again, with that greatest commandment, we love God with all of our hearts and our souls and our minds, and it's only from that overflow that we are able to really and truly love our neighbors. And we consider each and every person to be our neighbor. And so I hope that you will perhaps come and see us at Triune. If you'd like to come and take a tour, you are always welcome. But my name is Amanda Taylor, and you can look up my email address. It's amanda@triunemercy.org, and we'd be happy to have you come and tour to see what we have to offer at Triune. And I will say that we're also led by the Spirit. And so that's what we offer at Triune will sometimes change because the Spirit is on the move. And we praise God for that. And so I appreciate your time this afternoon, and I'd love to hear, do you have any questions about Trinity Mercy Center?
I have one question.
Yes.
Do you guys require
on Sunday mornings, we ask that participants that are going to have lunch with us come to our worship service. And that's not for a theological reason, it's more of a practical reason. We don't have the staff to monitor outside of the church as well as inside of the church on a Sunday morning. And so we ask everybody to come inside on Sunday so that we can all be together and then share a meal together after the service. But outside of Sunday, there is no requirement that you would participate in church services. Are there other questions? All right, well, I certainly appreciate your time, and I look forward to hopefully maybe seeing you again. Thank you.
Thank you so much.
Okay, so now I'm gonna just introduce Justin Cazel, who is gonna be presenting our CLE today. I'm gonna ask him to tell you a little more about him, but he's a wonderful friend of the center, is a great resource for us. He's actually hosting us at, the South Carolina Bar for the Family Court Mediation Training upcoming in, October. And he was also gracious enough to offer to do the CLE for us. So I'm gonna go ahead and have him come up and we'll begin. Thank you, Justin.
Thank you, Jennifer, for allowing me to come. Good afternoon, everybody. I know many of you from a variety of different places and circumstances, so it's good to see some friendly faces here. It's always good to be able to share what I do, especially something like this. I have been a mortgage lender with South State Bank since 2005, and for years and years, I was traditional, meaning I would do purchases and refis and construction loans and all the things that a traditional mortgage lender would do. At this point, my business is really kind of 50-50 in the divorce world as well as the traditional world. We, as South State, have 5 locations across Greenville. We have 12 in the entire upstate. So we're a good regional bank. When I joined the bank, we were a good local bank, but we have grown a little bit. And now we are, a couple of years ago, we merged with a bank called Center State out of Florida, maintained our name, maintained our board. But it was a good coming together of organizations. Today, I want to talk to you about divorce lending. And about a year ago, a little over a year ago, the market was changing in the mortgage world. The different traditional worlds were slowing down, rates were coming up. And I was wanting to do something that was a little more meaningful. I'm a stage past. If you've heard the learn, earn, return about the 3 periods of your life, I'm kind of stepping out of the earn into the return. So I figured this would be a good way to return a little bit. I've got a background in some chaplaincy work and some pastoral work, and I think that my technical banking skills matches well with the pastoral work in this world. So that's where I am coming from a professional perspective. My wife and I have lived in Greenville since '96. We have 2 great kids that are both out and gone, but consider Greenville home. Hope we never have to go anywhere else. So this afternoon, I'm going to talk to you about divorce lending strategy. And this is a CLE. So if you haven't signed up already, there's a sign-up sheet in the back. We will submit that to the bar for you. So that will be taken care of on your side. This presentation is meant to be interactive. So please put your hands up if you have questions or shout it out. Because if not, I'm going to just be sitting here going through PowerPoint slides, which is boring for everybody. So let's not go in that direction. From my perspective, divorce lending is something that I've done many times for the last 18 years, but I didn't realize how many mistakes I made. And mistakes meaning, how could I have put somebody in a better position with certain skills and background and knowledge that I didn't have as a traditional lender? So the Divorce Lending Association provides training that is specific to divorce. As a Fannie Mae lender, the Fannie Mae guidelines are that thick, but most lenders use just the first 10 pages as being able to be effective in their work. The Divorce Lending Association provides training in the rest of it to pick out nuggets and learn different things that are specific to being able to have somebody have a successful outcome in a very uncomfortable situation. So first thing to know is that we don't practice law or give legal advice. We don't practice tax accounting or give any tax advice. We count on a divorce team. So if somebody comes to us, we want to make sure that they have a divorce attorney, that they have an accountant that will be advising them on tax advice. And if not, then we can help put them in the right place. Because it's very important at the very beginning of the process to engage somebody like me as a CDLP, Certified Divorce Lending Professional. So there are pieces of the puzzle when it comes to divorce. There we go. So you really have a melding of areas of a person's technical life. You've got family law, you've got real property, you've got tax planning, mortgage planning. And people say, what does mortgage planning mean? Well, it's the ability to look at the big picture and try to come up with a plan that takes you from day one of, I'm thinking about a divorce, through the decree. So it's holistic, and it is looking at the entire picture. And it's the disconnect of where maybe some of those things aren't being considered as settlement agreements are putting together and as going through mediation and those types of things. So that's where the value of the CDLP comes in. So this next slide is a little busy, but it supports and it shows those four areas: family law, real estate, tax, and mortgage. And it just shows how integrated and intricate they all can be. So this is just one way that you can show all of these coming together. We had a training not too long ago that described how there are tax advantages if you're refinancing out of a house to split that asset, how you're going to benefit from having a higher rate. Because right now rates are fairly high. They're higher than they've been in 20 years. And most people are in 3% mortgages, and they're thinking, oh my goodness, I'm going to have to give up that rate. Well, if you look at the tax world, then at that point is where you can say, okay, your mortgage interest deduction is going to triple or go way more. And that is enough to right there to look at a certain advantage. But then you've got other things where if you are paying off debt or other worlds when you're talking about refi, then that's the situation where it's not the worst thing in the world to be refinancing into a higher rate. So all sorts of different areas that the CDLP focuses on to try to come up with a bigger outcome. So at this point, what questions can I have? I've got all sorts of specific and kind of technical information going forward, but any other questions that are here? Yes, sir.
With the expansion of the standard deduction for most couples, does the interest that they have been paying during the year have as much impact on their planning as if they have in the past?
Well, that's going to depend on each person. If they have other itemized deductions that may come up to or past the standard deduction. So it really comes down to looking at the math to figure out. But of course, there is less opportunity for the larger interest deduction, but it's still there. And it's really just a matter of looking at that math.
Of the clients that you have dealt with, how many of them did it actually make a difference?
Financially?
Yeah, the standard, going beyond the standard deductions, that seems to have captured most people.
It is most people, and it's going to take a fairly unique situation that is a true benefit. But if you take a look at other debts that are being paid off versus the higher rate and those payments that are going to offset based on their $800 car payment going away, but their mortgage payment going up $400. So it's hard to say a direct answer to that question. Several. And I would say in the last year, I've worked with 30 clients and 5 maybe that have had a true benefit. Does that answer your question?
Yeah.
Okay.
What you're saying is it's more holistic than I thought.
Yes, very much so. We'll take a look at that here in just a second. It's very, very, holistic is the right way to put it. So, successful divorce. Nobody likes divorce. It's not a happy time, regardless of the situation. So what makes a successful divorce? Well, it comes down to us looking at the big picture, looking at all four of those areas of integration, and try to sit with somebody in a really tough time to help them see the big picture. If you have somebody who maybe hasn't been the main breadwinner or hasn't managed finances or doesn't understand the tax world as much, that person is going to be completely overwhelmed. And I'm sure you all have seen that. And so if you can step back well before the MSA is put together or any other sort of settlement is discussed, then we can help you with specific verbiage in an agreement that can set both parties up for success. If you have the spouse that's leaving the house, perhaps help them be in a situation where they can buy a house. If you have the spouse staying in the house, well, maybe there are ways that we can help that person stay in the house. We'll talk about specific income sources and income strategy in just a bit. So again, the question comes down, what makes a divorce successful? So it's really just a matter of taking a look at everything. And the outcome is what's most important. But as you know, you can't plan for an outcome without taking a look at the whole process going forward. So the first meeting that I have with a client is to discuss what do you want? What is this gonna look like at the end for you that it works out? And I think sometimes the kindest thing that I can do at that first meeting is say, you're not gonna be able to do this. And maybe come up with other strategies to suggest, okay, here's what you can do. Come back to me in 6 months after you've done this for this. So it really comes down to determining what the outcome is going to be, or what the desired outcome is, and aiming for that through that process. So what are some things to think about in your world? If you are mediating with a family, how do you determine the value of the home? That's one big question. And a lot of folks will say, well, I get an appraisal. Well, that's the best way to do it. But what if you were to get an appraisal at the beginning of the process, and then when it comes time to provide the financing, that value is different? And if you're talking about a year difference or 9 month difference right now, the appreciation of house value is pretty drastic. So if you have a house that appraises for $500 in January, you start to get some settlement or some agreements in place in October, the house is not going to have the same value. So what's the value going to be when you get to that point? So if you have somebody who wants to keep the house, but we can't show the fact that the out spouse can afford a new one, what are you going to do in that situation? Well, like I said, the easiest, kindest thing sometimes is a hard no. Just sorry, not now. What if somebody has commission income and it's hard to determine what a steady source of income is going to be? How are you able to come up with some sort of support number that allows, that's fair and allows the spouse receiving the support to have the income necessary to do whatever their outcome is going to be, whether it's stay in the house, buy a new house, or rent for a year, or provide, be able to pay for soccer, or the things that are very important in a divorce situation. So what if somebody gets a lump sum? You may have a big bank account, but you don't have any income drawing off of that bank account. Well, there are ways that you can source that income to determine an effective number that can be an estimate for down the road. So then how do you manage the equity portion of the house? Who gets it? Why do they get it? Can you reduce the amount that is negotiated? Can you look at other debts that might bring into the situation where instead of a 50-50 split, maybe you get a 20-80? So if you're really looking at a marital balance sheet to determine what's the fair disposition of the asset. So those are some things to think about that we ask every time. That, you know, it's very important for us to know what that person's big picture is. And I feel like that is the very first meeting is the key to the success at the very end. Yes, ma'am.
I have a question that's a little more up for the prior threshold question, because we've said in people that even the entire team.
Mhm.
You know what I mean?
Yeah.
That's like a solid amount.
Right.
I'm just wondering if you have a for, what kind of asset level or income level or whatever. What is the set of people where they even consider going down further?
Anyone who owns a home, regardless of the income level. Because you're right, if somebody has the means to hire a team, they may have a little more sophisticated knowledge, they may have a tax accountant, they may have a CFP, and people that can come together. But in this situation, anybody who owns a home needs to talk to somebody who can have some technical expertise and a background. Does that answer your question? Yeah, you're welcome. You're welcome. So what's the planning piece? It is the ability to really focus on the outcome, what everybody wants, and put in place all the puzzle pieces that work with the real estate, the taxes, the legal world, the settlement agreement, that bring them all together and say, here's where we want to be. And down that bottom line is exactly what I mentioned earlier. We don't give any tax advice. We don't get any legal advice. We are not CPAs. We're not, I don't know if there are any CDLPs that are members of the bar, but we're not insurance agents. We're not realtors. So that is information that we don't have the practical licensure to give advice. So we want to help divorcing homeowners make the best of decisions and put themselves in the best possible position to get that outcome. So this next slide is a little busy. So you've got the journey from discernment all the way through moving into your own house or keeping your own house. So that self-reflection piece, where do they come to you when it comes to this this busy slide? Do they come to you in negotiation or settlement or a combination of those? And that was a question, not a rhetorical question. So what's the best spot for you all to get involved? I used to be a teacher, so I can be really patient. I'll wait.
We get involved if we're through upstate mediation.
Right.
Normally already in court. They're already moving forward to hearing, and maybe a long ways away, maybe closed.
Right.
And we're expected to deal with this in about 3 hours.
Right.
So we're not really capable of referring them to a bunch of people necessarily, and then saying, come back
Right.
after you've resolved all these parts, and we'll try to put it together.
Right. That's right. Well, so you're coming in around the settlement phase, the green phase, is that right? Or are you one step before the negotiation?
I would say that, the very first phase is part of the mediation for where the needs. One of the actions is the home. Then as a mediator, you're going to find out, well, what does each party want in terms of, where the needs want. I would say it's a very.
Gotcha. Well, that's where I want to be involved too. And it's not always going to work out. If we find somebody at the settlement phase and they don't have any sort of strategy or idea of how to become fair and look at the outcome, then even if I am coming in at the green phase, there is still a benefit for somebody to talk to a certified divorce lending professional. So that's where I want to get involved in the orange section, but we can get all the way to the green section and still be effective. Does that speak to you? Does that make sense to you?
A comment to you about mediation. You're dealing with people that are best, mostly very fragile.
That's right.
And many times looking for revenge, looking for, get that down.
Yeah.
They're not thinking rationally. They're not thinking about this. I would suspect that I would say, based on my experience, majority of people we find in mediation haven't really given any of this kind of thought.
Right.
they're trying to figure out either how am I gonna survive
Mhm.
in this end, or how am I gonna make this SOB pay
Yeah.
for everything they've done and not done.
Right.
Kind of thing. I mean, you know, it's a little different. The topic of housing, if they have housing,
Mhm.
comes up quite a bit.
Right.
I mean, you know, what's gonna happen to that? You know, so, that comes up quite a bit, but, one of the things that might help you understand our dilemma is that as mediators, the second we begin to even very slightly be, away from being total neutral, we've lost our effectiveness as a mediator. You know, we have to remain total,
Right.
you know, and that's one of the most difficult things, not anyway.
Yeah.
So, yeah, but the housing certainly comes up.
Right.
The good news, at least in my experience, tells me that the stuff is relatively easy.
Mhm.
There's a fair amount of case law on it.
Yeah.
Yeah, but the intangible things are very, very different.
Right.
Yeah. So, I'm looking at you, and I'm looking at Sharp, and I'm thinking to myself, you know, it would be great, it would really be wonderful if people we were talking to had already gone down this path quite a bit.
Right.
And already had a good idea
Right.
what they were thinking about.
Right.
And, but if there's gonna be, ever going through divorce, there's no very little rational thinking.
Right.
I mean, you know, so, that would be, your start up there is very, very true, very, right on the money as far as I'm concerned. I mean, it's things you ought to be doing.
Right.
But, unfortunately, the challenge would be to get them into that before they ever really begin talking and negotiating or deciding what's gonna happen with how they're gonna divide everything up.
Mhm.
No, yeah, you're absolutely right. I mean, there's so many critical things that have to be decided,
Right.
but many times divorce is very, very emotional.
Right.
It's not intellectual. And,
Right.
Many times they come in and, they have only one thing on their mind. I'm gonna get the heck away from that, or I wanna make that person pay.
Right.
I mean, that's all they're thinking.
Right.
You know,
Yeah.
but fortunately, there's a fair amount of, case law on,
Mhm.
you know, a fair amount of, you talk to, most, any family court attorney, they're talking about what we're gonna do with this. I get a pretty good idea what the judge is.
Right.
I mean, you know, and so, so it's difficult.
Yeah.
It's difficult. I really wish that, I'm sitting here thinking, oh, goodness, I think to myself, boy, it'd be lovely, it would be great to have somebody come to mediation that's already walked down this path
Right.
and thought it out
Right.
rationally
Right.
and did it. I would think that would be the best service or thing that they could be doing,
Right.
you know, so, but candidly, it doesn't happen.
Right. That's right. Well, the emotion is a key part of what you all do, is managing emotion, sitting between two people who either don't like each other anymore or want what the other person wants. So in my world, as a traditional lender, my guidelines are black and white. There's really not much I can do besides what Fannie Mae tells me I can do. In this world, it gives me the ability to drill a little deeper, and be a peaceful presence. Most of the time, I'm dealing with one side of the equation, and not both. So that helps me a little bit, not have to manage what you all have to manage, which is the piece where you're sitting at a table with two unhappy people, more than one people. So the emotion piece, more power to you for putting yourself in the position where you might be there.
Many times, not all the time, but many times, people in the mediation process, the people who went through it, have an attorney.
Mhm.
And as you know, attorneys are very, very good, but that's a little bit out of their belly.
That's exactly
I was
right.
just sitting here thinking, it would be great if, they wanted to talk to an attorney, and an attorney said to them, boy, you really ought to think about this
Right.
Yeah, and then I can tell you how you gain what you want to get,
Yep,
when it's all over.
Right.
But you need to figure out what you want.
that's right. That's right. So, and this is just me thinking out loud, maybe when somebody says, I would like to come to the Upstate Mediation Center, say, all right, let's have you consider your mortgage first or consider your financing first. Not trying to say that that needs to happen, but to back up the steps to get there.
I would think, I would think that if attorneys, had your passion for what you're doing and understood it and knew a little bit about this, they could be very instrumental in getting started.
Yeah. Right.
But, when it comes to us,
Yeah,
in mediators, we're not gonna tell somebody anything that's gonna give them an advantage over somebody else.
Right.
I mean, so we're hoping that they already get it figured out, or we can help them figure it out.
that's right. Well, the attorneys that I work with, every one of them will say, how come I've never heard of this? So,
Well, yeah, I understand.
yeah, attorneys are the family attorneys are highly trained. They are going to be able to get you from A to B, but they don't know these guidelines. And that's where we can help. All to try to get down. Yeah, thank you.
Would your ethics permit you to meet with both parties just to discuss the option?
Yep, and I have sat in mediations before, after I've met with one or both, and there's a workbook that I prepare that I'll share with you all later, that is very helpful, in that situation. It's an unaudited inventory of assets and mortgage and debts and those types of things. So I'll share that with you in just a bit. But yes, I could sit with both. I've never done a mortgage for both, and I don't necessarily want to go in that direction. But I would be able to refer that to somebody within South State and the Upstate that I can help from the divorce knowledge side. I'm the only CDLP in our bank. There are a couple more that are in the state, but yes, we can work with both parties at the same time. Yeah. So this next slide is also a little busy, and I can do most of this within a couple of hours. So once I meet with a client and get past step one, the 2, 3, and 4 is something I've been doing it long enough that I can see it quickly. I can look at those numbers pretty quickly and understand what the rest of this looks like. Vetting the house is the very front of the process. What do you want to do with the house? Do you want to sell it? Do you want to buy something else? Do you want to stay in it? So vetting the house isn't necessarily getting the appraisal done at that point, but it is trying to determine how is it titled now? Is it joint tenants? Is it owned in common? So lots of different ways that we can look at the titling of the house to also determine an outcome. So it's not just can be quit claimed into somebody else's name or something along those lines. So vetting the house. Qualifying the income is something that I kind of can do in my sleep these days, just based on how I've done it. But there's a little bit of creative license in terms of being able to look at different ways of income. Looking at debt, I'm going to take a look at a credit report, hopefully a joint credit report, to see who owes what debt's out there that maybe the other person doesn't know about. All sorts of different things that are debt related that might come up down the road. I think, Carol, you've probably seen it at a closing table where somebody says, well, who is James Smith? And that's, somebody might not know that the person has been married before. So anyway, lots of different things to look at the debt. And then at the very end, let's take a look at an appraisal to determine how much equity there actually is and figure out how to get there. Step 5, it's hopefully a peaceful presence, something that everybody wants. The decree is stamped and the judge is done, and everybody is in a successful spot according to where they are from the very beginning. So income, I mentioned I can qualify it in my sleep these days. It is not deep math. It's not rocket science. There are some guideline pieces that can be more in-depth analyzed, where if you have somebody that is reporting an income of $2,000 a month, well, maybe we can look at some depreciation to add that back. There are different ways that we can say, okay, we can add $500 a month here. Or if there's a lump sum settlement, we can be creative in how we use that income. And when I say creative, I know just a few minutes ago I said we're black and white, but being creative can mean looking into the black and white guidelines and finding some things that aren't in those first 10 pages. So, lump sum. Let's say you have a quadro scenario where somebody's getting $1 million 401k. Well, that's great. You've got a lot of money in the bank, but how are you going to generate income off of that? There is a way with a lump sum. You can set up an alimony trust. It's there in the trust, and the trustee and the grantor and the beneficiary all can be the same person. So that person can write themselves a check, write out a simple letter that says, I am the trustee of this Justin Cazel Alimony Trust, and I will be disbursing $10,000 a month. And write one check to yourself, that income is then qualified. So a lot of folks will say, if you're just getting this lump sum, there's no income ability, and that's not true. And that's common all through the mortgage world. I'm sorry, you can't buy a house right now where if you'd spoken to somebody who has a little bit more in-depth guideline knowledge, you can. Documentation guidelines and child support guidelines. Employment income is easy. Look at a pay stub. We determine if they've been employed for a certain period of time. With support income, one of the most important things to know is that there's a 636 rule. You have to receive it for 6 months on the agreed upon schedule. So if the agreement says must be paid by the 5th of every month, well, this is Fannie Mae's logic. If it's paid on the 6th, 1 month, that 6-month clock starts again. So that is certainly not ideal, but it is what Fannie said. So that's where we can come in and say, you must pay your agreed upon support in the first 2 weeks of the month or the first week of the month, as opposed to putting a day on it. Because if you say it's got to be paid by the 5th and that's a Sunday, that might cause some potential risk down the road. So I think I may have just skipped ahead a couple of sources or a couple of slides. So let's see here. Yeah, I did. I skipped down the road. The paper trail piece is important. So how do we determine whether it is paid? Well, the best way is a check. Get check image for 6 consecutive months that say this is being paid to John Doe for $4,500, and we see that consistent receipt every month. And the 36-month continuance is important because it has to remain as a viable support payment for 36 months post-closing. So if you have child support that starts when a child is 17 and it ends when that person is 18, we have to consider that. So we're going to look at the settlement agreement and the additional documents that say how long is this child support going to continue. So that 636 rule is very important. And netting out support is something that is also important. If you have the person paying the support that earns $10,000 a month, we don't want to take that support out of their income. We would rather take a look at that as the full month as a liability on their credit report. And that way their debt to income ratio isn't hit so much. Now that's kind of some voodoo math that I can show you on paper later, but that's one area where a lender is going to say $1,000 a month support is $1,000 a month support, whether it's on the income side or the liability side. And it's just not true. If you have somebody if you reduce that $10,000 a month to 9, as opposed to creating that as a liability, you're talking about a 1/12 split over the year, as opposed to a 1-month split of that $1,000 in reduction of income. So that's a place where a lender will go, sorry, you can't afford the house, where if you take a look at the net income piece, probably can, or it's much more advantageous. Sometimes you see a 20 or 30% difference in debt to income, which is one of the ratios we look at, if you don't net out the support. So an illustration of that, let me show you later if you're interested in how that works. So that is a stable and important piece. So,
I have a question.
yes,
About the receipt deadline.
yes,
Now, so much stuff is done through apps. and
Right.
things like that. Well, I mean, if you're getting paid through PayPal or
Yep.
Venmo or things like that, do those
that's acceptable.
reports generated by them and that stuff?
We ask that there be a memo that says August support or September support, just so we know what it is and we can track it and know that it's not paying for somebody's football team. So yes, it can be done. And transfers among bank accounts. If they still have a joint bank account, you can't pay yourself support. So you need that money, you need to be out, it needs to come from a separate bank account going into a separate bank account. So that's another thing that's very important, is that if it's a joint bank account, it just makes no sense to the underwriter. Say, well, John is paying himself support, that just doesn't work. So just keep that in mind as well. Does that make sense on the support continuance? Okay. All right, so if we go back to the employment support, the lump sum is one of the most creative ways to do something. Because you can take that $1 million 401k and generate assumed income off of that 401k. So in lieu of monthly support through qualified income, you can just assume, all right, I've got $1 million. You can either start paying yourself through the trust, or Fannie will allow you to take that asset, that cash, and give an assumed split. So if you have a 15-year loan, which is 180 months, if you can split that, you can take $1 million and divide it by 15, we're going to be able to use whatever that number is for Fannie Mae. So that's another creative way to look at income. And 72T is a distribution that can be put in place in lieu of a 401k. That gets technical, and that's where I would bring in a CPA or somebody that can give some tax advice on whether a 72T is something that works for anybody. And then we're going to think of, how can we get as strategic as possible and stay within the guidelines and look forward to the desired outcome for both folks.
I have a question about the 72C distribution.
Mm-hmm.
I know this is more of a tax question.
Right.
But I am familiar with that distribution. What I'm not sure is, can both spouses utilize that?
I would think so. I should probably take the easy way out on this one and say, I don't give tax advice.
Right.
But I would think so if they have the qualified assets to do that.
Okay.
So maybe that is, from the guidelines perspective, I would proceed with both parties being able to receive that income, and then I would check with an underwriter.
Yeah, I probably should check.
Yeah, and most underwriters aren't even going to know what a 72-2ET is.
Right.
So, yeah, that's where I would go to. I'd probably pick up the phone and call my accountant.
Yeah.
Can you?
Yeah.
So, yeah, good question. All right, variable debt. This is a very important one for the reason that we spoke of earlier. If debt is joint, the debt needs to be counted fully. The liability, the payment needs to be counted fully against both parties. So if you have a settlement agreement that says spouse A will pay this car loan, we have to have a 12-month receipt of that car loan being paid by the other person. So if you've got somebody who is going to stay in the home and both are on the mortgage, both of those liabilities, that liability is going to count twice. So the agreement needs to state, we're going to split this asset. And that's what the biggest mistake is sometimes when when an attorney says, you're probably not going to be able to keep the house. There are times when we can make it work. Maybe it's a matter of some sort of assumption. And assumptions are possible, meaning you assume somebody else's mortgage and that other person comes off. So through an assumption, you can have somebody removed from them. So all sorts of different ways that you can take a look. Joint debt on credit cards is a big one, because you may have somebody who's an authorized user on a credit card that doesn't even know. And that isn't necessarily anything that is being fishy for one party or the other. It's just a joint credit card they got. And what's the first thing that somebody's not going to pay if they are struggling? They're going to pay their mortgage first, but you know that credit card bill, I'm not going to worry about that one right now. And credit cards will crush credit scores if they are not paid on time. Had to deny somebody this morning, and it's the worst thing ever. First-time home buyer who had late payments on a credit card a couple months back. Their score was at 800 when I first started talking to them. Now it's 600. So joint debt is crucial to understand in a situation like that. So if you have somebody coming to you in a mediation session and you don't fully understand their debt scenario, then that's where there's a potential for you not being able to have the best outcome without all of the knowledge. Does that make sense? Okay. So over the past 18 years, the first thing anybody goes to is an equity buyout when you're talking to a divorcing client, which is, I'm going to refinance the house. I'm going to take whatever equity is in it. I'm going to do a cash out up to half the equity. I'm going to pay you off at the closing. Still happens often. And sometimes it's the best way to do it. And sometimes it happens like that. Everybody agrees. I walk away with my $100,000, which is half the equity. But an equity buyout is not necessarily an official loan type. It's just a strategy by using what's called a cash out refi. And Carol, you've probably closed lots of cash out refis in your world. Fannie has an indication that allows anytime you have somebody that's on title for 12 months to refi and not be hit with any sort of cash out penalty. Fannie will price a cash out loan higher than if you're doing what's called a rate term, meaning just taking a $100,000 loan, refinancing it into another $100,000 loan to reduce your rate. So if you have a $200,000 loan and you need to make it a $300,000 loan on a house that's worth $400,000 because you'll be splitting that equity, Fannie will stick it to you. Your rate will be about a quarter point higher unless you are able to set it up in a different way where that pricing adjustment doesn't hit. So that's where looking at the equity, looking at the strategy of the refinance makes a whole lot of sense and makes a potential better outcome for everybody. So let's talk a little bit about the actual house itself. So when you're talking about the marital home, you have to look at it independently of other assets because of titling issues and those types of things. When I said cash out earlier, I said no cash back, and that means to the borrowing spouse. So if I am refinancing my house and I am taking my loan from 200 to 300, it sounds like there's going to be cash back, but it's going to somebody. So if that person is on title for the last 12 months, and that guideline may have just changed, we've got a Fannie notice that they may have changed it to 6 months. But if that person is on title, they can get that cash out. And as long as the borrowing spouse doesn't walk away with an extra $1,000 because the loan amount was calculated a little bit incorrectly, then there is no cash out penalty. So that's a good way to look at things from the cash out perspective. If you have somebody who's splitting the house with an equity buyout, then that's where you want to take a look at either whether you want to purchase the property or not. And sometimes it makes more sense to purchase the home from the outgoing spouse as opposed to doing an equity buyout. There's trouble, or not trouble, but there's some technical things you may want to think about there. Can you buy a house from yourself? Not really. But can you take somebody a quick claim deed off and then have that person buy it? Well, then you might be hit with a due on sale clause if you change the ownership of the property against the servicer of the mortgage. So the servicer might not like the fact that you've taken John Doe off the mortgage so Jane Doe can buy it. So in those situations, it's important to look at the titling of the house and the desired titling of the house. Make sure that you're putting things in a doable position. So you can see here the bottom arrow says he must have been on title for 12 months to refinance at the rate term. That's the piece that I mentioned, no cash back. But I could potentially walk away if I'm the spouse that's leaving the house with my check and be all done with that house at that. Yes, sir.
what you just said about just being on the title 12 months to refinance. Do you also have to be on the title 12 months? Let's say you own the home outright. But would you still have to be on the title for 12 months and that? You don't want to.
So you own it with no mortgage?
Yes.
Yes. Yes, you would be. You have to be on the title for 12 months. Right.
Right.
Correct. So that zero back is important because if you get to closing and you're getting $1,000 back, our closer, who has the closing instructions from our underwriter, is going to say, I can't fund this because the borrower is getting cash back. So what we would do in that situation is we would reduce principal by that $1,000 just so there's no cash coming. So that's an important piece of the process there as well. So I've covered a lot of this stuff. I've talked ahead on slides. So we're going to take a look at the next slide a little bit briefly. In the settlement agreement, you've got to put the verbiage in a very concise and specific way as to who's getting what and what percentage of the home, the equity they're getting. Putting a dollar amount is often very tough to do because you might get a variance in appraisal when it comes out. Or what does somebody do if your escrow account, which is the account that holds your taxes and insurance, is way larger than everyone thought, so you're not going to be able to get that equity. So if you were to say, all right, we're going to give 50% of the equity to spouse A as opposed to $50,000 to spouse A. And that's where that appraisal matters, because if you do the appraisal on the front side and it varies from the appraisal on the back side, then the equity position isn't clear. Does that make sense? So the last button, escrows and existing tax liability. People often don't see that. You may have $5,000 in your escrow account at the end of the year. And that is not often seen as a marital asset. So that will go back to the borrowing spouse when that loan is closed and paid off. So XYZ Bank is holding that $5,000 to your benefit, and it's going to go to the holding spouse. That's really a marital asset. And that's in a situation as well where that should be in a settlement agreement, that you will split the escrow account. Taxes as well. If you have a $10,000 tax bill, the spouse leaving won't share in that liability if that is not agreed upon. So if you're in the 8th month of the year, you're going to have probably 9 months worth of tax escrows. That's coming back, but there's also that debt that the staying spouse will have to cover completely. So that's another thing that really needs to be considered. So if they could get both the escrow account and assume the tax liability, and those were exactly the same, theoretically those would wash out, but those don't always line up perfectly. So taking a look at the tax liability is often very important to know, and especially in Greenville County with the taxes rising as fast as they go. So I looked at my taxes the other day, and I don't live in Beverly Hills, but anyway, that's a different story for a different day. Are there any city officials here that we can talk to? So let's take a quick look at a case study. So let's say that the wife is getting the marital home and has to refinance within 4 months of the divorce being filed. So the husband is going to get his equity share, and in this case, it's a dollar amount. We're assuming the appraisal has already been done. Then the wife's going to get half of the 401k through a quadro. Do you ever, by the way, this is a question, not rhetorical, do you ever get involved with the disbursement or the splitting of retirement assets? Okay, so that comes to you as well. That's not before you all. So the wife's getting $500,000. There's debt of $8,000 on a visa. So there is also joint debt of $30,000 on an Amex. And the husband pays $1,200 in support for life and $800 a month until the child turns 18 in 2 years. So can we count that $800 a month? I think that we can, because it doesn't have 36 months to consume. The $1,200 is a no-brainer. As long as we have 6 months of receipt, that money will be coming to life, and so that's a healthy thing. So if we take another step here, that will be put into a case study that I prepare when I first meet with a client, and it's self-reported stuff. So, if they say my 401k is account number 7654 and it's with Raymond James, that's what I'm going to put in this report. So this is an unaudited report that I put together for mainly for the attorney. So that person has somebody to reference or something to reference. And you'll see how in-depth this can be in just a second. So we're going to take these numbers, we're going to put them into this worksheet here. So the next one is just the basics. You know, we've got the value of the property over here. We've got the insurance information. We've got the ownership information, how it's titled. So all of this stuff is basically specific to the mortgage in the house. So what else do we need to know? We have other things we need to know as well. So was the spouse on title for 12 months? That's important if we're determining how to divide equity. That's one thing that is going to be there. And most folks don't understand, most attorneys, and it's not because you all aren't educated, it's just because it's not your world, don't understand the 12-month title. So that's one piece that's very important. So then how are we going to value the property? Maybe an appraisal has already been done. And if that's the case, then we have to set expectations that we're going to need to do another appraisal. And that value may be a little bit different. So loan to value and the property equity is all very important. When I say loan to value, that's the current debt, mortgage, versus the assumed value of the house. So if you have a $100,000 house, $200,000 value, $100,000 mortgage, $200,000 value, that's a 50% debt or equity position. So loan to value position. So then we know that house spouse is going to get at $11,500 at closing. So that's a simple math there. So then let's look at the bottom there. The annual premium of the insurance and the agent there is, or the insured is John Smith. What is often overlooked is if you have a spouse who owns the house and the staying spouse is not on the insurance policy, that insurance policy covers the insured and not the property. So if you moved out of the house and you've quit claiming the deed, but the insurance is still with if you haven't switched the insurance over and a tree falls on the roof, well, that is not insured. So you've got to understand who is the named insured in a situation like that. I've never run into it, but it is something that through case studies and other scenarios, I've heard of it happening. That's tragic. Because if you have a contentious situation, one person may say, I don't know the house. This is your issue now. So that's why it's important to make sure that the insurance has moved into the current owner of the property. So the rest of the slides here are fairly technical. We're going to look at what's the first mortgage, what's the second mortgage, and then we're going to take a look at the equity distribution there. And all of these things automatically calculate through the Excel spreadsheet that I use, and that's going to give a visual to somebody who might not have a good idea of what these numbers up top. Can't think of them through fairly quickly, but you know, this is if somebody has the first mortgage and second mortgage, and it puts all those numbers together in that scenario. So, any questions so far on this workbook that we have? Yes.
I had a question about the appraisal.
Mm-hmm.
So I've been using in some of my cases recently a market analysis versus an appraisal.
Right.
They're cheaper, they're faster.
Yep.
There's some argument that it's actually even more accurate than a dual appraisal. But
Yeah.
what are your thoughts on that? How does that play into this? I know for mortgage purposes, you're going to want an appraisal.
Right.
And the lender typically has their own appraiser.
Right.
So if the parties have paid $500 for an appraisal through the negotiation process,
Mhm.
now the end spouse is going to have to get another appraisal.
Right. Well,
Thoughts?
divorce is expensive.
I know.
But yes, that's one of the main reasons we set that question up immediately, and that's why there's also that's why it's important to set a percentage in the settlement agreement as opposed to a dollar amount. Because if you sign that one person's going to be giving $60,000 to the other, if the equity is less than that, well, they're still bound to that $60,000.
Because your appraiser may come in different.
Right.
Ah.
That's right. But as far as a CMA, a comparative market analysis, We, for our equity lines with the bank, and this isn't a bank commercial, this is just one bank's process, we will use a CMA, a commercial, or a comparative market analysis. But typically we found that they come in a little bit low because they're electronic, they spit out a number and come back, and that's what we will often use for our equity. We won't do that in my world with the first mortgage, just because we're dealing with Fannie guidelines. Sometimes Fannie will come back to us and say, I don't need the appraisal. Well, in this situation, you do. It's very important to have a third-party valuation. So, what other questions on that? That was a good question. All right. So, who's the mortgagee? Who is the person that is named on the mortgage? And I may have just jumped ahead again on this. So, we know that it's John, the husband, and we know that the escrow balance of $9,500. That asset is joint marital property, regardless of who's on the deed, regardless of who's on the mortgage. It is marital property that somehow needs to be properly and fairly divided. And then the equity line. That's another piece that's very important. A client of mine who is working with right now, she came to me and said, there's an equity line on my credit report, has a zero balance on my credit report, but I just got a bill from the bank that says $10,000 has been drawn. It's crucial to know who has access to that equity line, because theoretically, if Liz Pendants has been filed, then you've got to get a temporary restraining order on the finance. Never happens, but it is something that should happen, just so you don't find yourself $30,000 in debt and your former spouse has the benefit of that. So very important to know if there is a second mortgage on the property. And that is, I hadn't seen that one until this most recent case, and it's potentially tragic to put somebody in a terrible situation that we didn't determine this until post decree. When they try to pay off the house or sell the house, and all of a sudden, the title agent comes back and says, we got to pay off the second mortgage of $50,000 as well, and they weren't counting on that. So then we've already discussed how the equity distribution is calculated. It comes through the tool that we use, and this tool is vital when it comes to looking at the big picture, because you may have an attorney that writes down all the conversation. This is me as a third party saying, here's what this is, and here's what this is. This document is very helpful, not only from the 2 steps back, but also when it gets to your world. And then this is the last thing. This is more of a qualification comparison. So here's what you might be able to afford. Busy slide, very busy slide. But it goes into, here's what a payment on an FHA loan would be, here's what a payment on a conventional loan would be, to determine, is it going to work? Is the spouse going to be able to do it? And we make a lot of assumptions in this as far as what the income is going to be agreed upon, but all this can be tweaked and twisted. It's a live document that can be changed at any time. So you can look at the different scenarios. What's it going to cost me per month? It'll put a graph together for that. Well, we may look at the first scenario, and we can see that that first option is not going to work, but on that second mortgage, still owes $51,500. See how small it is? I have to use my bifocals to get down here to take a look at it. I never thought I'd have bifocals until a couple years ago. So, yeah, we're going to look at the scenario there and realize, okay, we got $51,500. We also have to consider and pay off as well. So then let's move on to the next one. We got the escrow account that we've talked about as well. That needs to go one way or the other. And you can do that as a split of equity if you want, where if you're splitting $100,000, you may have Jane get $91,500 or $90,500 instead of that, but just by deducting that escrow balance, the escrow refund. And here's more, more technical stuff. I'm happy to go through this report step by step. There are a few of them on the back table, but if you are looking for one, I can email this to you and we can talk it through line by line, so you have a little bit more information on it. But then we get to the point where we're looking at the child support, the spousal support, and this is where we have to determine how long it's going to continue. All of these things are laid out in one document, so the attorney or you as the mediator can see it and say, all right, here's where we need to aim. Here's where we need to try to get to. So then we need to also look at the percentage of the payment, percentage of the equity that's coming back to them. So I know what's our time? How's our time?
We are at 1:06.
What do we have? One. All right. Then let me get quick here. We've got a $500,000 quadro settlement, cash in bank, lots of cash, no income. So then what happens? But we know that the staying spouse needs $2,500 a month to be able to afford what he or she is trying to do. So that $2,500 a month is what has been agreed upon, perhaps with a 3-year continuance. So we need $90,000 in order to generate the income necessary for that person to go that way. Because the $2,500, you take the 90 divided by 2,500, that's 36 months. That's where that number comes from. So we can do a couple things. We can create that alimony trust that we talked about. We can use $100,000 of the lump sum to fund that alimony trust, and I can create a distribution for that. You can have you can go online and create your own trust. Now, I wouldn't recommend it because you're probably going to put a wrong click somewhere, but so a trust attorney can put together a trust for a few $100. So if I take that $100,000, I can create $2,500 in income every month for that person to be able to use that $2,500. So if we do that, we don't need to worry about the 6 months of continuance, and it meets the 120 deadline for being able to last 120 for the trust. So that's something I didn't mention before. With a trust account, you have to assume that the money in the trust account will last 10 years. So that is different from the 36-month continuance. But if you have $1 million and you're taking $10,000 a month times 120, you're going to have enough income there to support what you're looking to do. Kathy?
The number one takeaway for us when we're dealing with indigent people, or
Mhm.
nearly indigent people, is this whole idea of one party or another refinancing within so many days of the final order, and most of the other stuff that starts. If they're just getting a job, they're not going to be able to pull it off.
Depends on the job, depends on their background. If you have somebody who was a nurse and then they haven't been working for 4 years and they go get a job as a nurse, we can count that.
Even though it's not 6 months received.
Correct. Correct. Now, if somebody goes into a self-employed world, that's not going to work. But if you're a W-2 nurse and you were a nurse 5 years ago, you're going into the same realm of work with me. Yeah. Somebody's a nurse and then they go and become a pilot, that's different. But same line of work will do. All right, so then this is pretty much what we just talked about. The distribution can be once a year, can be once a quarter, as long as it meets those guidelines. If you want to just write yourself a check for $90,000 off of that alimony trust once a year, that works just fine as well. All right, so here's where we are. We've got this intersection of all of these financial and legal components of someone. When I'm sitting down with them, I'm not saying, here's what you have to do, here's your legal advice, here's your tax advice. But what we're doing is looking at a whole picture and saying, have you thought of this? Maybe you should talk to somebody about this. So putting strategies in place to help come up with our outcome. So settlement agreements are often putting somebody in a tricky spot because of certain verbiage that can be 2 or 3 words. As you know, many of you are attorneys, so you understand the importance of verbiage to a minute and tiny little level. So that's the same as what we can look at here as well. So we look at the agreements all the time, and it's something that we have a good knowledge of to put and get the proper and the desired outcome for everybody in place. Now, here's the piece that is probably very important for you to know, is that the Equal Credit Opportunity Act does not allow me to collect a fee. So my compensation comes when a loan closes. And that could be 6 months or 12 months down the road. And loan officer compensation laws say that's the only way, the only time I can get paid. So it's going to cost your client nothing at all, because they don't pay anything to the lender. Well, it costs lender fees, but that's down the road. That's the same as any mortgage put in. So just know that when I am meeting with an attorney and I tell that person that we don't charge a fee, that's where the attorney goes, wait, because it's not something that has to be discussed when it comes to the big picture. So that's all I've got. I am grateful for the time and you sticking around an extra 10 minutes. And if there is anything that I can answer for you, you can come up to me now. I've got cards if you want to set a time to talk or talk on the phone or whatever it may be. But thank you for the invitation and for allowing me to be here. Thank you, Jennifer.
Thank you so much.
Are you dismissed now, or do we have something closing?
We are dismissed.
Dismissed.